If you own a rental property in Santa Barbara that is worth $1 million more than what you paid for it, selling it the ordinary way could hand the IRS and the state of California a check well into the six-figure range. A 1031 exchange is how real estate investors legally defer that tax, and sometimes they do so for the rest of their lives. Let me show you exactly how it works, the two deadlines that trip people up, and the California rule that almost nobody tells you about. So what is a 1031 exchange? A 1031 exchange is named after Section 1031 of the Internal Revenue Code. And in plain English, you sell an investment property, and instead of paying capital gains taxes, you roll the entire proceeds into another investment property of equal or greater value. The tax does not disappear. It is simply deferred. A 1031 exchange, like I said, named after Section 1031 of the IRS code, lets a real estate investor sell an investment property and defer capital gains taxes by reinvesting the full proceeds into like-kind replacement property. As of 2026, Section 1031 applies only to real property held for investment or business use. It does not apply to a personal residence. And since the 2017 Tax Cuts and Jobs Act, it no longer applies to personal property such as equipment or vehicles. So the two deadlines, this is where most exchanges fall apart. There are two hard deadlines, and they both start ticking the day your sale closes. In a 1031 exchange, you must identify your replacement property within 45 days of selling, and you must close on it within 180. Both deadlines start on the sale closing date. They run concurrently and have no extensions except in certain federally declared disasters. 45 days to identify in writing, and then 180 days to close. If you miss either one of those, the whole gain becomes taxable, and the 1031 exchange is not doable. That is why you plan the exchange before you list, not while you are in escrow. Here are the rules that make it work. One, like kind is very, very broad for real estate. You can exchange a Santa Barbara rental condo for an apartment building, raw land, a strip center, or an industrial building anywhere in the United States. A qualified intermediary, otherwise known as a QI, must hold the proceeds. If the money touches your bank account, then the exchange is dead. And to defer all of the tax, you must buy equal or greater value and reinvest all of your equity. Any cash you keep is called boot, and boot is taxable. So to fully defer tax in a 1031 exchange, the investor must buy a replacement property of equal or greater value and reinvest all of the equity. Any cash kept, known as boot, like I said, is taxable. Now, here's the California rule that nobody mentions. California has a clawback provision. So if you 1031 exchange a California property into an out-of-state property, the state of California tracks that deferred gain on Franchise Tax Board Form 3840, and it taxes it when you eventually sell that without exchanging again. So yes, you can absolutely exchange out of state. Plenty of my clients trade Santa Barbara rentals for property in Texas, Arizona, Nevada, but California does not forget, and we plan for that up front. Why investors love it? Well, because you can keep swap until you drop in. 1031 exchange can be repeated indefinitely. When the owner dies, the heirs receive a step up in basis equal to the property's fair market value at the date of death, which can permanently erase the deferred capital gain. This is the quiet power of strategy. You just defer, defer, defer during your life. Then your heirs inherit at today's value, and that deferred gain you carried for decades can vanish entirely. A 1031 exchange also defers the depreciation recapture you would otherwise owe, which is normally taxed at about 25%. So say you bought a duplex here in 1998 for $350,000, and today it's worth $1.6 million. your gain is roughly 1.25 million. And if you stack up the federal capital gains, the 3.8% net investment income tax, depreciation recapture, and California income tax, which taxes capital gains as ordinary income up to 13.3%, and your combined bill could approach $400,000. And so a properly structured 1031 exchange defers all of that, keeping that $400,000 working for you in the next property instead of sitting with the tax collector. So here is the honest part. A 1031 exchange touches your realtor, your qualified intermediary, your CPA, your financial planner, and your attorney. And my job as the real estate planner is to quarterback that team so the pieces move in the right order and nothing gets missed. This is transitional, not transactional. And if you own investment property in Santa Barbara and you are wondering whether an exchange makes sense for your situation, book a no pressure strategy session at the link below or call me directly at 805-456-3667. Talk to you soon. Cheers.